Good morning, traders. This is your Forex market commentary brought to you by ECN. In line with today's commentary, we will touch base on the dollar-yen market. A quiet trading week for the dollar-yen market as lack of leading economic report out from Japan failed to induce volatility. Fed Chair Janet Yellen continued to remain accommodative on monetary policy while geopolitical tension between Russia and Ukraine has eased. I hope that this commentary will prove to be insightful in formulating successful trading strategy. First, in line with this commentary, we will touch base on the dollar-yen market on the technical front. The narrative of the dollar-yen price action for this week's trading session has been relatively muted due to the lack of risk event out from Japan. The dollar-yen heads into this week's trading session breaking down below the 102 level, and one of the contributing factors that caused the sell-off in the cross can be linked to the Chinese HSBC service PMI number, which grew at a lower pace than previous reading. It is also important to understand that China can affect Japan on two fronts. A slowdown in China can potentially trigger a risk aversion that stems from emerging market concerns, and risk aversion tend to have an adverse effect on the dollar-yen cross. The second component is China is Japan's largest trading partner, therefore a slowdown in China can potentially hamper Japanese corporation earning as well as manufacturing. Ultimately, this can hamper the indicator to find momentum by which the dollar-yen cross is highly correlated to. During Wednesday trading session, the market observed the dollar-yen second attempt to retest the 102 level on an upbeat Chinese trade balance print which grew better than expected. In accordance to the SSI, which is also known as the Speculative Sentiment Index, net retail traders continue to long the dollar-yen on every opportunity that the Japanese yen would rally. Currently, there are 2 long dollar-yen positions for every 1 short position taken up by retail traders. Therefore, analysts would suggest taking the contrarian standpoint to this crowd sentiment and suggest that near-term dollar-yen weakness is yet to materialize. On a larger time scale, the dollar-yen cross appeared to be trapped in a congestive trading range. Such pattern would suggest a near-term breakout, and the trigger of this breakout will often come in the form of a shift in fundamental viewpoint. Analysts are also suggesting paying close attention to the 101.35 critical support level. Failure to sustain trading momentum above this level would trigger a sell-off in the pair. Analysis of a collection of technical indicators on the hourly interval on the dollar-yen market suggests a temporary bearish market sentiment and recommend short positions on the greenback. The hourly chart showed that the dollar-yen pair opened today's Sydney trading session inching closer to the established short-term Fibonacci support at 101.62, while Fibonacci resistance is set at 101.69. The pair opened today's Sydney trading session below the 200-day simple moving average. What this entails is that the long-term outlook on the dollar-yen cross has been downgraded to bearish if the trend line continued to trade below the 200 days. This trend action holds great significance as 200-day simple moving average contains more or less 1 year's worth of trading data, and it forecasts long-term market sentiment. The bearish long-term outlook on the dollar-yen pair is also shared by its short-term moving average counterpart as the dollar-yen market opens today's Sydney trading session above the 5, in line with the 10 but below the 20 and 30 day simple moving average. Collectively, this is very indicative of a sell recommendation on the technical front. This sell signal is also confirmed by the CCI, which is also known as the Commodity Channel Index, as the price action of the dollar-yen continued to trade within the boundary below the 0.00 price value. Now moving along to the fundamental aspect of the dollar-yen market. This week's Fed Chair Janet Yellen testimony did very little to provide clarity for the market in terms of monetary policy. The dovish Fed rhetoric would only help to keep the cost of borrowing down on long-term U.S. Treasury. Janet continued to reiterate to the Senate Budget Committee that she will keep interest rate low for an extended period of time until robust economic recovery can fully gain traction. The greenback continued to sell off against the yen despite an upbeat report on U.S. jobless claim print, which fell from 345K to 319K. In addition to that, U.S. continuing jobless claim also fell from 2.761 million down to 2.685 million. Monitoring the development between Russia and Ukraine is vital in gauging where the market sentiment sits on risk-on, risk-off scale. Tension between Russia and Ukraine eased when Putin calls on the separatists to postpone the pursuit of a referendum on independence, also reassuring this peacekeeping effort Putin vowed to do all it can to resolve the crisis. To conclude this commentary, I want to thank all of our listeners for their time, and until then, have a great weekend, everybody.